The UK retail sales report was an absolute disaster. The steepest drop in nearly a year hits the tape. And what does sterling do? It barely flinches. Price is parked right here at 1.3430, flat as a pancake, compressing energy like a coiled spring. That is not normal behavior. That is the footprint of a massive trap. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end, because I'm giving out 3 exact entry and exit levels you can place right now, and I'll tell you which cross-asset signal from the dollar and the euro proves this move is about to be violent. Right now, I'm issuing your instant market verdict. The session bias is range-bound compression with a bullish lean, fading the retail fear into a structural support floor. However, this is a coiled market, so we treat every level with surgical respect. The one invalidation level that proves this bias wrong is 1.3360. Write this number down. If we break below 1.3360 today with a 4-hour close, the entire bullish structure fails, and the trapdoor opens to 1.3300. That is the line in the sand. While we hold above it, the pound is a buyer's market. Let me repeat that. Invalidation sits at 1.3360. If we lose it, the dollar killers are dead, and we flip aggressively short. Now let's walk through the technical deep dive exactly as I see it on my screens. We start from the top. Monthly time frame shows a strong buy signal. Price is carving higher highs, and the trend is unambiguously bullish. Zoom into the weekly, and the structure remains a buy. We've had a shallow pullback, but nothing has broken the sequence of higher lows. The daily, however, has shifted to neutral. And this is where the tension lives. The daily candle is indecisive, trapped right around the moving averages. Look at the moving average values on the daily. The 5-day moving average is at 1.3424, the 10-day at 1.3440. The 20-day is at 1.3457, and the 50-day comes in at 1.3468. The 100-day is at 1.3451. So we have a cluster of moving average resistance between 1.3450 and 1.3470. Price is currently below that cluster, which is why the sellers think they have control. But the 200-day moving average is sitting down at 1.3380, acting like a brick wall of dynamic support. This is the great compression. On the daily MACD, we are reading a negative value of minus 0.001, essentially flat, reflecting perfect equilibrium between buyers and sellers. The RSI on the 14 period is at 47.6, dead center, no man's land. This data screams one thing: a breakout is mathematically inevitable. Drop down to the 4-hour and 60-minute charts to get granular. On the 1 hour, we have a strong buy signal, indicating short-term momentum is trying to push north. The 5-hour is neutral, so the very short-term algos are pausing. What do we see? A slow grind away from the key support zone. The critical support numbers today are 1.3396, which is the immediate swing low, and then 1.3360, which aligns with that 200-day moving average I just mentioned. Key resistances are 1.3462, right at that moving average cluster, and then 1.3492, the recent swing high. The price action is essentially building a pressure cooker. Every time we touch 1.3396, buyers step in, but the resistance ceiling at 1.3462 keeps the lid on. Here's what most traders miss. While sterling is fighting its own domestic weakness, you must cross-check the euro. The euro-sterling pair is leaking lower, which means the pound is actually the stronger of the 2 European currencies. That relative strength flows directly into cable. If euro-dollar is struggling below 1.09 and euro-sterling breaks below support, that becomes a turbocharger for any pound-dollar upside breakout. We are the dollar killers, and right now, the dollar index is looking tired. Let's connect the last 24 hours of fundamental news directly to this chart. The headline screamed, "Pound flattens as UK retail. Sales post steepest drop in nearly a year." This was a triple miss. The consumer is on its knees, yet sterling did not collapse. Why? Because the market has already priced in a struggling UK consumer. The smart money is looking straight through this lagging indicator and focusing on the policy divergence between the Bank of England and the European Central Bank. The ECB is openly signalling rate cuts. Services inflation in the Eurozone is crumbling. The Bank of England, however, remains cautious. UK services inflation and wage growth are still sticky enough to keep the hawks at the table. This yield differential is critical. British gilt yields are holding a premium over German bonds, and that spread is widening. That bond spread acts as a magnetic force pulling capital into sterling, specifically against the euro, and that crossflow is what puts a bid under pound dollar at these support zones. The narrative web is clear. Dollar weakness from the back of soft US data, combined with pound strength on the crosses, creates the perfect setup for an upside resolution. My 1 to 2 week directional lean is bullish as long as we stay above 1.3360. The target is a retest of 1.3600. The event that would invalidate this thesis completely is a hawkish repricing of the Federal Reserve via a hot core PCE print, which would kill the dollar weakness leg of this trade. But right here, right now, the path of least resistance is a snap higher most. People will skip this section, but this is where money is made. Keep watching. We are going into the trade setups with surgical precision. I have 3 distinct strategies for you, depending on your risk appetite. The first is the sniper, the conservative play strategy 1, the sniper. You are not chasing anything. You are waiting for the trap to spring and then confirming the breakout. The exact trigger condition is a 4-hour candle close above 1.3465. That confirms absorption of the moving average cluster and breaks the psychological weight of the range. Once that 4-hour candle locks in above 1.3465, you enter long. Your stop loss goes at 1.3430, below the intraday value area and below the broken resistance turn support. That gives you a 35 pip stop. Your target one is 1.3505, which gives a 40 pip move, and your target 2 is 1.3555. The risk reward on target 1 is over 1 to 1, and target 2 pushes it past 1 to 3. What voids this setup? If price pokes above 1.3465 but immediately reverses and closes back below 1.3450 on the next 4-hour candle, that is a bull trap. You step aside. This is a sniper entry, clean, high probability, no emotions, strategy 2, the active trader. This is the standard approach for those who want to ride the compression inside the range. You are playing the retest of the support before the breakout. Your entry condition is a pullback to the 1.3400 level, but you need a confirmation signal. Wait for a 60-minute bullish engulfing or a sharp pin bar rejection off that zone. The entry trigger is exact at 1.3400. Your stop loss sits at 1.3380, right below the 200-day moving average. That gives a 20 pip stop. The logic is solid. You are buying at the value area low with a stop beneath the institutional floor. Target 1 is 1.3460, taking out the immediate resistance. When target 1 is hit, move your stop to break even. Target 2 is 1.3490, the upper boundary of the compression. Once target 2 is approached, trail your stop by 25 pips to let the breakout run if it comes. The risk reward here is dynamic, but you are capturing roughly a 1 to 3 profile if both targets hit. This setup respects the range and uses the retail sales fear as your entry fuel. Let's see how aligned we are. Type your pound-dollar range for tomorrow's session in the comments right now. Give me your high and your low prediction. I'm reading them, and I'll pin the most accurate forecast. This builds our community edge, strategy 3, the aggressor. This is high risk, and only for those who know how to lose small and manage risk aggressively. You are fading the last panic push into support without waiting for the perfect confirmation. The entry is a limit order at 1.3398, just above the critical 1.3396 swing low. You are betting that the retail sales fear wick will be bought instantly. Your stop loss must be tight at 1.3384, just below the psychologically important 1.3390 and slightly beneath the 200-day moving average. That is a 14 pip stop. Your target 1 is 1.3450. Target 2 is 1.3480. The risk-reward here is aggressive, roughly 1 to 3 against target 1. However, the risk of a stop hunt is high. If price spikes through 1.3396 and you get filled, but it doesn't recover within 2 60-minute candles, cut the trade manually. No hesitation. This is for traders who understand that the best entries feel the worst. Explicit warning: the volatility on the back of the retail sales data could trigger a false breakdown. Only execute this if you are comfortable with a rapid loss. Never risk more than 1 to 2% per trade on any of these strategies. Your risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like US GDP or BOE speeches. Stops are non-negotiable. Treat them like oxygen. Here is the close and your retention loop. The single most critical level for the next session is 1.3396. If that level holds, the coil releases north and we target 1.3550 within days. If it breaks, the trap snaps shut, and we are heading to 1.3300. Tomorrow we have the US durable goods data, which will test the dollar strength. I'll be covering that in detail, mapping the exact reaction levels for the dollar index. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen, because the correlation fracture I'm tracking there is about to cause a massive volatility spike. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one, where we hunt the next trap.